In 2025, some of the Golden State's hottest cities are poised to cool off at an alarming rate. California's housing market is shaking, and not just from earthquakes. For the first time in years, buyers are calling the shots as listings pile up and home prices slide. From tech hubs to famous beach towns, let's dive into the 10 California cities where home prices are expected to crash in 2025, painting a stark picture of the impending real estate crash. Which cities are witnessing inventory explosions? Where are home prices in freefall? And is your dream home about to lose $50,000 in value overnight? This is a vital housing market update and a critical housing market prediction for anyone invested in the Golden State's real estate market. Number 10, Los Angeles. The postcards still sparkle, palm-lined avenues, luxury estates, Hollywood's glow, but 2025 has LA's housing market waving red flags behind the curtain. County-wide medians sit near $850,000, yet momentum is negative. Several neighborhoods show 2 to 4% annual declines, and on near million-dollar properties, even a 2% move knocks roughly $17,000 off value. Supply is the tell. Listings are up around 50% year over year, buyers are choosier, and discounting has gone mainstream. In early 2025, more than 40% of properties posted price cuts, nearly double the share from 2 years back. It isn't just Beverly Hills. Northridge, West Adams, and Eagle Rock are cooling too as buyers negotiate hard and close below asking. Financing and risk costs are doing damage. With 30-year fixed rates hovering near 6.8 to 7%, the typical monthly on an average LA home now tops about $5,500 with 20% down, versus roughly $3,800 a few years ago, pricing out broad swaths of would-be purchasers amid sticky inflation and layoffs across tech, media, and entertainment. Layer in the wildfire zone insurance crunch, major carriers stepping back, coverage scarce or costly, and monthly budgets can swell by hundreds to thousands, crushing affordability further. Bottom line, the glamour remains, but the market is flickering. A trifecta of rising costs, thinner demand, and swelling inventory could recast the city of dreams as California's biggest real estate cautionary tale in 2025. Number 9, Stockton. A classic boom-bust city, Stockton was ground zero in 2008. Prices halved, bankruptcy followed, and in 2025, the strain is reappearing. After peaking near $480,000, median values have slipped about 3%, and rising supply plus slower sales hint. This may be the opening act of a broader cooldown. Inventory is up more than 45% year over year, and time to sell has stretched from 27 days to roughly 44. Discounting is spreading. Roughly 38% of listings now show markdowns, nearly twice the national norm, signaling motivated sellers and fatigued demand. The frenzied energy is gone. The market feels measured, even hesitant, with buyers taking longer and pushing for concessions. The pandemic surge of Bay Area buyers chasing affordability and space has faded as office commutes return and remote work flexibility narrows. Couple that with mortgage rates hovering near 7% and tighter underwriting, and a swath of would-be purchasers gets priced out before they start. Local fundamentals aren't helping. Unemployment near 7% and slower wage growth keep many on the sidelines, including younger buyers waiting out the uncertainty. History suggests Stockton swings harder than most when the cycle turns. This isn't a total collapse, but the caution lights are bright. 2025 could be the year the market turns decisively colder if inventory keeps building and affordability fails to improve. Number 8, Riverside. Once the budget-friendly alternative to LA, Riverside and the broader Inland Empire aren't sidestepping the turbulence in 2025. After a pandemic run-up of roughly 40%, the median sits near $575,000 and is now down about 2.5% year over year. with many expecting more softness ahead. The faster shift shows up in supply. Inventory is up sharply versus last year, and time to sell has stretched from days to well over a month as price cuts touch roughly a third of listings. Leverage has swung toward buyers, and nerves are showing on the sell side. At a 7% mortgage rate, that $575,000 purchase pencils to around a $4,300 monthly payment before taxes and insurance, enough to push many households past comfort. Deals are taking longer, counters are common, and discounts are becoming routine as the market cools. Investor behavior and local frictions add to the drag. Some pandemic-era investors are exiting, occasionally at a loss, while on-the-ground realities like heavy traffic, wildfire risk, and thin transit make shoppers pause. Fresh, new-build supply on the metro's edges is giving buyers more options, undercutting urgency, and ending the buy now or be priced out forever mindset. If prices keep slipping while listings balloon, Riverside's glow could dim further in 2025 and foreshadow broader weakness across Southern California. For now, conditions resemble a market tilting buyer-friendly as inventory builds and affordability bites. Number 7. Bakersfield. Long considered California's last truly affordable big market, Bakersfield drew first-timers, retirees, and households fleeing coastal costs with medians near $385,000. But 2025 finds that value proposition under pressure. Prices are down about 1.7% this year. Inventory has surged roughly 48%, and seller anxiety is starting to show in the data and on the ground. The surprising turn, even affordable, isn't feeling affordable anymore. At close to 7% mortgage rates, a typical monthly payment near $2,800 on an average home strains budgets in a city where many households earn under $60,000 per year. Add higher fuel costs, stubborn inflation, and rising insurance, especially after wildfires and drought, and carrying costs stack up fast. Discounts are spreading as well. About 35% of listings now show price cuts, and open houses that once saw lines are noticeably thin. Local economic headwinds aren't helping. Agriculture and oil, the regional pillars, face pressure, prompting more shoppers to consider out-of-state options with lower all-in costs. The rental side is cooling too, nudging some investors to exit and even pushing landlords to list properties for sale. Adding to supply, it isn't a full-blown freefall, but momentum is fading. With inventory climbing, demand softening, and affordability stretched, Bakersfield's market is losing steam and could tilt toward a more significant downturn if financing costs stay elevated and job growth remains uneven. Number 6. San Jose. The golden goose of Silicon Valley, once defined by tech-driven demand and million-dollar closings, has hit the brakes in 2025. After peaking near $1.4 billion, median prices are drifting lower by roughly 1.2 to 2% year over year, with more softening on many watch lists. The backdrop has shifted. Headline layoffs at major platforms, a cooler embrace of full-time remote work, and buyers balking at office proximity premiums are all chipping away at urgency. Financing adds friction. With mortgage rates hovering near 7%, the monthly nut on a $1.4 million home now tops about $9,200. Steep even for high earners. Inventory has climbed roughly 35%. Time on market has stretched to over a month versus the 10-day sprints of 2021, and about 30% of listings are posting price cuts as sellers meet the market. A crash is unlikely given deep local wealth, but the correction is real. Even entry-level stock is seeing markdowns, and negotiating power has shifted. For the first time in years, buyers hold meaningful leverage in a market that long felt untouchable. Number 5. Ventura. Coastal charm, surf culture, neighborhoods, people idealize. Ventura has all the postcards covered, yet the 2025 market has cooled. The median sits around $820,000, up only about 0.4% year over year, with several watchers expecting that trend line to slip negative if conditions persist. Inventory across Ventura County has risen sharply, roughly 41%, leaving more homes idle and days on market stretching, particularly in Oxnard and Camarillo, while nearly a third of listings are cutting price as shoppers slow down and negotiate harder. Affordability is pinched from multiple sides. With mortgage rates hovering near 7%, a median priced payment pencils close to $5,600 before taxes and insurance. Layered on top, coastal insurance premiums are jumping, often 20 to 30% year over year for some owners, further straining budgets. That squeeze plus caution is translating into longer marketing times and a more deliberate pace at the offer table. Tourism softness and policy shifts are reshaping the investment landscape too. Short-term rental demand has ebbed, investors are stepping back, and tighter Airbnb rules in parts of the county are making STR math tougher than a year or two ago. With higher active listings and slower absorption at certain price points, urgency has drained out of the market. Ventura's appeal hasn't vanished, but the shine has dimmed. If rates stay elevated and buyers keep waiting, 2025 could turn chillier than hoped, opening the door to deeper price cuts across segments that were red hot not long ago. Number 4. Oakland. For years, Oakland was the more attainable cousin to San Francisco. Similar bay views, milder weather, lower prices. In 2025, that era has clearly shifted. The median sits near $767,000, down roughly 6% from a year ago, a notable comedown after the 2021 frenzy. The buyer pool that swelled during remote work's peak has thinned, and demand feels materially weaker. Multiple headwinds are stacking up. At a 7% mortgage rate, payments on a $767,000 purchase land around $5,400 a month, beyond reach for many households. Inventory has surged, on some reads by about 50%, and more than 40% of listings posted price cuts in early 2025, signaling sellers meeting the market. Safety worries, higher vacancies, and slower local growth keep some shoppers cautious. The pullback spans segments. Flippers, investors, and first-timers are all more selective. West Oakland and Fruitvale are seeing deeper discounts, while Rockridge and Piedmont are holding up comparatively better. Even condos and townhomes are sitting longer than they did a couple of years ago. This looks less like a blip and more like a reset. Oakland now screens as one of California's more vulnerable big city markets in 2025, edging closer to a true buyer's tilt. And if inventory keeps building while affordability bites, a deeper correction than many anticipated. Number 3. Sacramento. During the pandemic run, Sacramento became the Bay Area's pressure valve. Buyers poured in and prices surged roughly 40% from 2020 to 2022. That momentum has faded. The median sits around the mid-$490,000, down from an approximately $540,000 peak and roughly 2.5% lower year over year, while inventory has climbed markedly since 2024. Listings that once sparked bidding wars now linger for a month or more, and widespread price cuts underscore a cooler tone. The urgency is gone, replaced by math. Near 7% mortgage rates put a median payment in the upper thousands, a stretch for many households. With a government and healthcare-heavy economy that doesn't see tech-style wage spikes, caution prevails. Many Bay Area transplants are opting to rent or sell rather than buy, and investors are tempering expectations as rents and returns level off. A 2008-style crash isn't in the cards, but a reset is. For patient purchasers, 2025 may be the best entry window in years, as inventory builds and pricing becomes more negotiable. On the ground, open houses are quieter. Buyers tour more and bid under ask, and even Midtown and East Sac, once bid war magnets, see longer days on market. Costs beyond principal and interest are part of the story too. Taxes, insurance, and utilities are rising, while wildfire and drought risks weigh on premiums, pressures that can tip first-timers out of the market. Some longtime owners are mulling downsizing, renting, or relocating to nearby spots like Davis, Roseville, or Folsom, as affordability and lifestyle math get recalculated. Number 2, San Diego. Sun, surf, tacos, and some of the priciest addresses in America define San Diego. But 2025 has even this eternal paradise easing off the boil. The county median sits around $875,000, and after years of relentless gains, values are slipping by roughly 2% year over year, with further softening possible if rates stay elevated. Inventory has swelled from last year's levels, tipping the balance toward buyers as sellers contend with longer market times and broader discounting. The supply surge is hard to miss. Active listings have jumped to roughly 6,000 from the low 4,000s a year earlier, and days on market now run past 40 in many segments, up sharply from near 10 during the frenzy 2 years ago. Nearly 40% of listings are carrying price cuts as buyers take more time and negotiate harder across both detached and attached markets. Affordability fatigue is front and center. At about a 7% mortgage rate, payments on a typical purchase can clear $6,000 a month. Tough math against the average local incomes near the mid-80,000s. With rate sensitivity high, many households are pausing or trading down in price point or location, reinforcing the slower cadence. Local crosswinds compound the cooldown. Tech-adjacent hiring has softened. Tourism is less buoyant than a year ago, and tighter short-term rental rules are pushing some Airbnb owners to exit, adding resale supply. Downtown and Mission Valley apartment deliveries are pressuring rents and nudging vacancies higher, further eroding investor returns in some pockets. Prestige neighborhoods aren't immune. La Jolla, Del Mar, and Pacific Beach are seeing more price reductions and slower absorption than sellers expected, with open houses thinner and coming soon listings lingering. Developers in the luxury condo segment are offering incentives and fee breaks, and some STR-heavy properties are hitting the for-sale market as yields compress. If rate cuts don't materialize soon, and if remote work patterns continue to evolve, San Diego's safe haven narrative could wobble further. The economy remains diverse, but with job growth slowing and inflation pinching budgets, a genuine correction, perhaps a mild one, has moved from unthinkable to plausible. In short, paradise isn't immune to market reality, and 2025 may be the first year in a decade when patience truly pays. Number 1, San Francisco. The tech capital and city of bridges, long synonymous with sky-high prices, looks notably strained in 2025. The median hovers near $1.12 million, roughly $40,000 below last year, a slide near 3.5% with some condo pockets and edge neighborhoods taking bigger hits. The energy that defined the boom has faded as layoffs, remote work optionality, and elevated living costs chip away at urgency, and a typical payment near $7,500 on a $1.12 million home, 20% down, before HOA and taxes leaves many buyers cold. Supply tells the story on the ground. Listings are up sharply year over year, and homes that once drew 10-plus offers now linger 45 to 50 days, with north of a third of properties posting price cuts. Even in historically hot areas, the calculus has shifted. Former residents can often buy more space elsewhere for what a small SF flat costs, and persistent transit and civic challenges are pushing some would-be buyers to look across the bay or out of state. This won't be a collapse. The city remains a global draw, but the sheen is dimmer, and negotiations finally matter. For patient buyers, 2025 could mark a rare opening. In No Valley and Pacific Heights, quiet D-list relist cycles and deeper reductions are showing up, while in Soma and Mission Bay, developers are dangling incentives, waived HOA fees, parking, and more to move units after months on market. It isn't just pricing. Lifestyle trade-offs, retail closures, and office woes are reshaping demand patterns, and rental softness in some corridors, along with elevated office vacancies and thin street-level activity, has dulled the pace that once defined SF. Longtime owners debate cashing out or riding it out as newcomers float lower offers. The city's only up reputation has cracked. The question now is how quickly it resets, and who seizes the moment while it does.